Thanks very much, Christian. So my name is Nick Philpott. I'm one of the co-founders of Zodia Markets, an OTC brokerage owned by Standard Chartered Bank. So to get the panel started off, I think we'll do some introductions from all five of our panelists. So Lily, would you like to start, please? And we'll go from right to left.
Sure. My name is Lily. I'm the president of the Solana Foundation. Stablecoins, payments are a big priority for us. I've been doing crypto for about 10 years, and I was originally inspired by the kind of vision of Bitcoin, peer-to-peer electronic cash. And to me, that implied a global payment system, by extension, a global financial system based on self-custody and self-sovereignty. I think that 15 years on, that vision has been still a little bit more articulated in theory rather than in practice, because there are a few conditions you need to have to start to realize that. One is that you need high performance network. You've got to have liquidity and assets that people actually want to use as a medium of exchange, hence stablecoins. And then third, you need to have a developer community to take it from payments into actual sort of financial primitives and products. And so none of that is easy to build, but I think that now we're kind of at a point where we can start to actually realize that original vision that Bitcoin proposed.
Hey everyone, my name's John. I'm head of business development at JST Digital. We are a crypto native trading firm focused on market making, treasury management, and deploying our own capital as a strategic venture investor. In terms of my background, I had started as an emerging markets, FX, and equity trader, and saw a lot of the issues in the legacy financial system that kind of my hobby of crypto drew me towards this industry. Started working at Circle in 2018, and kind of no turning back at this point in crypto for me, and it's been great working with stablecoin issuers in a variety of perspectives of trying to provide liquidity, create fair and orderly markets for all the efficiency gains that we see that stablecoins can provide, both for crypto native firms, but also legacy financial institutions.
Hey, I'm Colin Cunningham. I'm the head of tokenization at Chainlink. I've been there all of 1 month now, so still getting my head around the product set. But my mandate is to try and figure out from a product and ecosystem perspective, how should Chainlink be fitting into the entire tokenization landscape, and helping bring a more secure and verified kind of structure to how tokenized assets are transacted on chain. Obviously, stablecoins play a big part in that. Before that, I was at Centrifuge. I was there for 3 years. Centrifuge, if you don't know, it's a tokenization platform built in Polkadot. And I led the BD and growth there. So excited to be here, and thanks for having me.
Hi, my name is Matthew De La Fuente. I'm the CEO of Kayaks. We're a financial reporting tool for crypto businesses. With regards to stablecoins, so in December of 2012, I discovered Bitcoin and thought it was the most stupid idea ever, because what government would ever allow a currency to exist that they couldn't control, manage, tax, and govern? And even now, when I look at blockchain as a whole, stablecoins to me seem like the killer app. Stablecoins seem like the obvious use case for the world, for the places where currency security is a real challenge. And I'm delighted that Kayaks has found real traction amongst a whole bunch of stablecoin providers that are either linked to governments or are not linked to governments.
Morning, my name is Stefan Dreyer, Managing Director at the Association of National Numbering Agencies, also known as ANA. So we're a global trade association where our 120 members represent key market infrastructures, exchanges, central banks, regulators. So we come really out of the traditional financial world experience of 40 years assigning standard identifiers out of the ISO universe to financial and referential instruments. You may have heard of the ISIN. So unlike my colleagues here on the panel, not coming to this conversation from a practitioner point of view, but really looking at what are the things from a standards perspective that we can bring from traditional finance into the crypto space. And we've done a lot of work over the last several months, particularly working with our partners at the DTI Foundation, which is a Digital Token Identifier Foundation, coupling that with ISIN to provide a market solution for unique identification of assets.
So we'll start with our first question, and I'll start with you, Stefan. If you look at, probably already out of date here, but there's probably about 24 currencies that have stablecoins attached to them. Some of them, counterintuitively, are actually fairly unstable currencies. You know, the Argentine peso, the Nigerian naira, for example. So looking at terminology, is stablecoin really the right term that we should be using? And what would be the appeal of having something attached to something that's inherently unstable?
Yes, it probably is the wrong term. I think what ends up happening is you have these kind of things that come out when you have a novelty, somebody puts a label against it, but it very quickly becomes outdated because you start having variations of that. It's hard to lose that lingo, but I think what is important is that, you know, I talked about identification. One of the other aspects that we work on is classification, and particularly in the regulatory space, it's going to be about what is this thing and what does it do. That's going to really make the determination. So even if people are going to continue to refer to things more broadly as stable coins, you're going to have variations within there.
I think I would probably agree with regards to stablecoins as a category. I think it makes perfect sense from a marketing perspective. I think that technically there's a real challenge because inside of those stablecoins, the mechanisms are so different. And if we are looking at traditional financial regulations, it's actually the mechanisms that should be regulated. It's the mechanisms that should evaluate what type of product this is. And I think that there's going to be a real reckoning when stablecoin truly hits a regulatory wall.
From the tokenization perspective, it's absolutely the wrong name, but from my history, like we call them real world assets, right? Also, right, which is also a terrible name. Makes no sense to TradFi, right? From a risk-weighted assets perspective, which has always been a fun conversation. So stablecoin, in my opinion, is the wrong term, and it's especially for the transaction of tokenized assets. We need something that is actually stable, right? I think we can all agree that there's a wide range of what stable means and how that's interpreted across geographies and across different markets. I do think that it's okay that the stable coins have different risk parameters and serve different needs for different folks in different market contexts. But yeah, from the tokenized assets perspective, we'd like it to actually be stable. So I think there's a lot of work to do to just, I think the underlying mechanics, as you said, right, is probably where we need to get a little more clarity.
Yeah, I guess maybe I'll be the contrarian here. I do think it's a fine term in the sense that it should be, a stablecoin should be stable to the fiat asset that is theoretically underpinning it. You know, ultimately, fiat FX is quite volatile, and I think some of the name stablecoin comes from the fact that the early stablecoins were US dollar stablecoins, and a lot of people in this room have done great work of expanding the suite of what's out there. You know, ultimately, we look at something like, and maybe this is going to get controversial getting into this topic already, but what's happening in Nigeria right now, where they're pushing back on crypto companies because ultimately crypto companies are enabling local people to take a view on a currency that the government doesn't want. To me, that's an awesome use case of crypto, but also points to the instability of fiat FX.
Yeah, you know, it's just, the stablecoins is not, it's just a representation of however high quality or low quality that asset actually is. And what that's a reflection on is essentially sort of good or bad governance, and most of the governance in the world is terrible, right? So that's not the stablecoin's fault. It's reflecting much deeper ills that frankly is probably the reality that most of the people in the world live in, and frankly, you know, even here in the Western world, right? We're sort of living on the fumes of our former greatness. How many people here think that the dollar is going to have a debt crisis in our lifetime? Probably everyone. And so what it really is, it's kind of like it's a transitional sort of product for crypto adoption, because what you need is liquidity and a shared medium of exchange. And unfortunately, Nigeria, that is the naira, which depletes your wealth day by day. In Turkey, that is the lira. And we had what, 7-9% inflation in the supposedly stable Western world as well. How's that going? So, you know, that's, to me, stablecoins are the first tokenized asset, if you will. And there's going to be many other tokenized assets of all sorts and of all ranges. and many of them are going to be inherently unstable and get rugged, and many of them are going to go to zero. To me, it's just sort of the most viable medium of exchange that can be providing liquid collateral, and that is also a little bit sort of self-reinforcing in terms of whether it has inherent value on chain. And so what it really is doing is it's creating these sort of, these globally competitive markets that are essentially sort of proxy vote on the quality of governance. And unfortunately, I think most governments fail at that.
I think that sort of global nature of it, I think it's very, very interesting. And you touched on the dollar there briefly. I mean, a lot of people forget that there are two types of dollar. There's the domestic dollar and then there's the euro dollar, which we've had since sort of the 1950s. And I know parallels have been drawn between, say, USDC or US issued coins on the one hand being sort of US dollars and then something like Tether being an offshore dollar. So perhaps, Matthew, I'll come to you. Do you have any sort of comments or thoughts on that? And then to the wider panel?
Sure. So with regards to onshore and offshore stablecoins, let's just assume that onshore means that the company that you have set up, the foundation that you've set up to issue those stablecoins is actually located in the jurisdiction and governed by the jurisdiction of that native currency, and offshore applies to everything else. The sheer scale of financial products that we have yet to see and yet to build is staggering. If you look at FX as a proxy, I believe $9.5 trillion was traded yesterday, and the entire market cap of our entire industry, probably what, 2.5 trillion. We've got a long way to go. We have got so much space to innovate into. We've got so many variations to build that this conversation has only just begun. We are such a young industry. The regulation hasn't caught up. The market space hasn't matured. The VCs haven't invested where they could. I'm just incredibly excited about where we're going to go.
Wider group, Stefan, maybe you want to have a go?
Whether there's a greater need for it to see, I think it's all a perspective, where you're coming from the issuer side, from the investor side, from the regulator perspective. What is the benefit of understanding whether it's onshore or offshore? Like Matthew just said, I think very much in that vein, but whether a greater distinction is needed, probably personal preference.
Okay, well, so we've sort of crossed geographical frontiers. I mean, let's perhaps cross digital frontiers and look at execution. So maybe, Colin, do you want to touch on or give us an idea of some of the challenges, some of the risks involved, some of the difficulties in terms of execution and settlement between CeFi and DeFi? And if there are nuances specific to stablecoins, then perhaps touch on that as well.
When I think about the blockchain just globally, and the reason it exists, and I think it goes back to what you were saying, is the idea of cross-border payments, right, is kind of the killer use case in my opinion. I think it's still foundational for where I think the stablecoins sit, right? So when I think about tokenized assets, and I would agree, right, the stablecoin is probably the original, the foundational tokenized asset, and it helps me look at it a bit more holistically if I just think about it as tokenized asset rather than currency. From the settlement perspective, I think as long as when I look at stablecoins in that context of cross-border payments, it's undeniable. When we talk about how central banks will get involved, or we talk about how traditional FMIs and institutions will get involved, the idea of instant settlement, cross-border settlement, and the stablecoins use case in that perspective, I think when we keep it that simple and that focused, it makes it very simple for TradFi to understand the value proposition. I think when we start getting into the underlying mechanics, the variations in what a stablecoin is or does, or even the concepts of governance, I think TradFi just goes, whoa, this is a lot.
Speaking about your experience with Swift.
Yeah. I think it takes you down a rabbit hole of, well, did you consider this? Did you consider that? It's like, well, we can work through that. And I think everyone just goes, this is too much. But when we talk about everything that's happening around kind of the FX markets, you talk about cross-border settlement, you talk about how the instantaneous and kind of undeniable and immutable nature of smart contracts and cross-border payments, I think it is the one common thread that everyone can get on board with between CeFi, DeFi, TradFi, NeFi. And that's why stablecoins are so important to the conversation, because they're so uniting, especially in the payments realm.
John?
Yeah, I think, from a crypto practitioner perspective, I see it as a bit of a trade-off with the CeFi DeFi of almost transparency versus efficiency, in that centralized exchanges work pretty well most of the time, but you are oftentimes trading with a bit of a black box. We've obviously had some counterparty issues in our industry that a lot of people didn't foresee. In DeFi, you deal with some technical burdens that you have to be very aware of: protocol risk, smart contract risk, which we talk about from a trading perspective are oftentimes difficult to underwrite because they're binary. And so you take those trade-offs for the fact that you have a level of transparency that you don't have with closed source code. And that's, to me, kind of the original ethos of crypto, which is pretty amazing. And we're big believers in DeFi. We're big believers in stablecoins' role within DeFi. But you do have to approach it from a measured perspective of measuring those risks I already mentioned, working with folks like the chain monitoring tools, the elliptics, the chain analyses, the TRMs, to make sure that you're on the right side of AML and OFAC regulations that are going to continue to be a major topic. So again, it goes back to that transparency versus efficiency, and going in open-eyed to what your trade-offs are and how to manage some of those risks that I mentioned on the DeFi side.
Lily?
So I think that it's not just about payments even. Where this can go very quickly is because, if you think about it, these are all tokenized assets. And so if you can tokenize a dollar, you can also tokenize Apple stock, and you can eventually, but even before you get there, you can tokenize, we were talking about whiskey casks earlier. And so then if all of that is tokenized in the same fungible technology standard, then what you can do is I can pay you not just in dollars or Naira, I can pay you in shares of my whiskey warehouse. And that is where I think the governments are going to totally lose it, right? Because if I can now pay for my coffee with some fraction of Apple stock, this is not what regulators are at all prepared to be processing, right? But that is really sort of where we're going to be going, and I think that also changes the dynamics of what it means to be making these markets, right? Because if you have the ability to pay for coffee with Apple stock, then how do you even just imagine what needs to happen between DEXs and centralized exchanges as well. Just imagine what has to happen in order to bring efficiency and arbing out that market to sort of to keep prices as they should be. So that to me is like the wild kind of future that we're going to be going into faster than we know it. And to me, I think that the regulatory sort of face off with crypto is there will be no, I think, sort of congenial settlement, as it were, of that, because inherently what crypto proposes is a competitive governance market, right? A competitive market for governance, and this is proxy expressed in stablecoin. Let's say all of the fiat currencies in the world were all represented on-chain. Would the distribution in the digital world reflect the distribution in the fiat world? Of course not, because you're going to have all this flight to safety of the US dollar, right? And it's not just because of liquidity, it's also because of the security of that asset, which is probably the one thing which will probably stave off sort of the US's fiscal predicament in the moment. And so given that, I think those of us that are thinking that we're kind of going to, all kind of work it out within existing regulatory frameworks, I think that's just very unlikely.
It's very interesting. I went to university in Scotland and thinking that if they get independence, perhaps a whiskey-backed currency could be on the cards.
Yes. Now we can talk about digital gold and consumption versus store value, and so it's
very different concept of market liquidity as well.
Very different type of discussion there. So.
Anyway, sorry, Matthew, do you want to have a go at the question as well?
No, I think I'm good. I think everything's no.
That's fair enough. Okay. So maybe, John, I'll come to you. So in terms of booking, I remember 2018, Standard Chartered, quite an old bank, we did a test trade using Bitcoin, and we watched it go through the Indiana Jones wrecking ball, destroying every system it touched, including the general ledger. So what tools do you need to be able to book, to manage the risk of, to execute, to settle digital assets and stablecoins? Perhaps we'll start with you.
Yeah, I can speak again from working in a few different shops at this point, but having specific tooling to monitor that entire life cycle at this point
there's a lot of people building a lot of great products, but it's still disparate. There isn't one, in my opinion, if anyone has it, would love to chat later, killer app for institutional OMS, PMS, that's order management, portfolio management software. But I think, taking a step back, thinking back to my traditional finance life, as everyone here who's worked in big banks has probably remembered, the systems are cobbled together. The experience that you went through was because things have been built over the last 30 years, and it's been, everything works, but it kind of works. It's all duct taped together, and it's moving trillions of dollars of value every day. I think ultimately for stablecoins to be adopted by traditional financial institutions, they're going to need to see that the benefits to them outweigh the costs of undoing a lot of what they've built to enable crypto to not go through this wrecking ball that you guys experienced. And again, it's kind of the classic buy versus build versus partner. And in that regard, it's almost like traditional firms need to realize they can partner with crypto by adopting into their systems. So.
Stefan?
Yeah, I would say that, yes, the tools are bulky and taped together, but I would say that for crypto, you need the same tools. You need to be able to do the same type of exercises. You need to do it in a different way. Data management, risk management, you need those for transparency, regulatory reporting. You're going to have a lot of the same requirements that you do with traditional assets. I think and I'm going to do a selfish plug here for standards. Standards is another tool, right? You have to have something that threads all of that, that helps create that interoperability so that you know that the asset that you're looking at going through that life cycle is the same one. And if we look at the DPI, that becomes the novelty in defining that asset to be able to look at what is exactly happening at the DLT implementation level. So definitely, I think standards as well.
John, I agree with you, and I think everyone here understands that we're all going to have to build an equivalent stack in digital assets as we have done for TradFi. I fear it's going to look as cobbled together, as vampiric, as hacked together on Google Sheets, as TradFi is hacked together on Excel, but that's my own concern. I think for everyone here, the most interesting use case that we've actually had is what I've called accidental crypto. It is non-financial services companies. These are traditional businesses. Think Hamleys, think your local hardware store, who've accidentally decided to accept Bitcoin, who've accidentally decided to accept a stablecoin, because of course USDC, yes, I understand it's the same as USD, and okay, we'll accept it. And the finance team gets bullied by the salespeople to accept the payment in USDC because this particular customer has special needs. And the finance stack then accepts that they have to deal with USDC. And then all bets are off. They have to systematically build, accept, buy an entirely new stack to deal with this single asset that has dropped in their ecosystem. They have to build or find a way to store that asset through custody. They have to find a way to report on it. They have to find a way to reconcile it. They have to find a way to jam it into their accounting systems. They then have to find a way to either sell it or store it. I'm going to tell you that the vast majority of our customers who fall in this accidental crypto space simply store it because the finance folks are so scared about getting it wrong. And that opportunity, that megatrend, may be a significant one, especially on the stablecoin side.
Lily, I'll probably bring the next question to you. So in terms of taking finance on-chain, effectively putting it on the internet for the first time ever, I mean, how do you think that's going to transform traditional finance? And what do you think that we're going to find that's, perhaps as Matthew was saying, is unexpected?
Yeah, so I think even before you get into, let's call it very novel assets, I'm going to use the whiskey example as like kind of, that's, before you even get there, let's just talk about the assets that we all kind of know and love. Stocks, bonds, credit products, that type of thing, money markets, right? That's what everyone's into right now. I think that because of the kind of the very near-term case for, call it tokenization and securitization, is that in the current system, because you operate on stacks of paper, right? Just the operational nature of being able to economically reach, sell, and execute a market related to a certain audience is limited, right? Which is part of the reason why you have minimum thresholds to be accepted as a private wealth client. You have minimum investment thresholds to get into certain alternative investment products, and then sort of access of certainly sort of the mid or even the longer tail to varying degrees of financial products is increasingly limited the more sort of nouveau you get and that's just kind of the way it is, right? So if you want to be, who gets to be an LP into KKR North American Fund, right? Very few people, and they would actually like that potential investor base to be larger and more liquid, right? Of course, with some discretion, and then there's certainly a long tail of folks that would like to have some, fractional access to that, but it's just not practical for that market to even be executed, because the way it goes right now is, you have the client partner group go and pitch a bunch of LPs for tens of millions minimum of dollars, right? And there isn't a way to sort of open that up in a way which is operationally feasible. And so to me, it's a little bit sort of iPhone, Uber. Now you can clear a market of riders and drivers real time and a much smaller scale. And then in aggregate, open up create a much larger market. And so I think, near term, those are the types of things that become very feasible. I think people really see that in sort of like this next horizon. And then what I think becomes interesting is the ability to, for example, take my soul-bound token, whatever non-transferable assets in let's call it private equity fund, and then the banks can seamlessly lend to me against, let's call it $10,000 in this fund asset, and then I can easily get a loan for $5,000, right? Those are the types of things you literally can't even do on Web 2 because of sort of clarity around ownership and then sort of liquidity of and ease of transfer. So those are the types of things that I think I can see the value in it very clearly. I think those mechanisms ideally are going to be put in place. And even if it's not sort of, like the more novel end of the world, I think that will be valuable to a number of people and will actually be like a fairly happy collaboration between blockchain and traditional finance initially. I think there are a lot of crypto peers who are like, it's just going to be Bitcoin taking over the world, okay? And we should dominate the world in Satoshis. I don't disagree with that eventually. But in the meantime, we have to be cognizant of the fact that the vast majority of liquidity is sitting in the existing financial system, and we need to be practical about that.
So last 2 minutes, John, I'll come to you and then go through the others. But in terms of use cases or transformation, evolution, revolution, what's exciting you most in terms of stablecoins?
Yeah, I'm going to go super micro and simplistic, and it's things that are not currently possible with the fiat banking rails, in that we made a venture investment a few weeks ago. It's a very small company, needed the cash immediately. For whatever reason, their bank had an issue with them receiving our wire. They reached out and said, hey, our bank hasn't been receiving any of our wires. And we said, hey, can we just send you USDC? And they said, of course. Within 5 minutes, they have their investment, they can meet payroll, they can fund their AWS costs, whatever it is. And to me, that's so obvious of where the legacy financial system has not kept up, and where stablecoins are just an immediate potential boon to, again, this is just one small example of supporting a startup that, without even going way more macro of what this could do for far more complicated transactions. It's really exciting, and it's a big reason why at JST we're big believers in stablecoins, big believers in what this ecosystem can do, and very excited to see what happens the next few years.
Colin?
So I think I'm most excited about the transparency that we can bring to stablecoins by better understanding the underlying collateral. We don't have time to get into this, but just I think most people understand just how much of the collateral is sitting off chain and kind of custodian and various holding accounts, and we're getting reporting on this typically monthly or quarterly, right? What I start to get really excited about is when we talk about bringing more of the collateral on chain, more of the data on chain, so that we can start to understand not only the NAV or the price of the asset that you're investing in, but understanding the performance of the underlying on a daily basis, if not more frequently. So that's where I start to get really excited.
Matthew, and then finally Stefan.
The honest answer is pretty much everything. I think that once more currencies get on-chain, once more counterparties start engaging with trading, start moving towards FX initiatives, which I know Nick is helping lead, I think that not only will that be a huge boon to the stablecoin industry, but I think it will probably transform the way traditional finance looks at this industry as a whole. FX is one of the closest analogy industries to crypto in general. And once those traders get a taste for what, stablecoin FX can do for them, I have a strong suspicion that this industry will have another significant bull run, and I'm here for it.
Yeah, so when I started in my role 4 years ago, I knew zero, other than the man on the street, Bitcoin, blockchain, heard those terms before. But there was a common kind of theme that there was lack of regulatory clarity. Not much was happening to bring things together. And I would say that certainly from my observation in the last 6 months to 12 months, there's been a huge trajectory in the evolution of crypto regulation. You see it in Hong Kong. You've got MiCA coming into force. So all of that is providing this positive tailwind. And you see a lot of the traditional firms moving out of the cobwebs and corners to look at these projects, look and building their own platforms, coming together with new organizations that are very focused and specialized in the crypto space. And I think that is a tremendous tailwind to developing greater interoperability. You've got the efficiency gains, you've got new investment opportunities. All of that comes with risks, new risks that have to be carefully watched, but I think a very positive outlook.
Fantastic. And on that positive note, we'll close the panel. Thank you very much to my panelists. And thank you to Chainlink and the Stablecoin Standard. And look forward to following up and chatting outside over a coffee. Thank you.